Hi, I'm Ann Wilson-Welshef, and today I want to talk about one of my favorite topics, index trackers. If you've known me at all for a shorter period of time, you know that I love index trackers. These are these juicy, amazing investment vehicles, assets, the way for you to get and own and control amazing stocks and shares of companies all over the world for real low cost, so your money gets working for you and not for the financial industry. But a question that I get the whole time is, Anne, what is the difference between an ETF, an exchange traded fund, and a unit trust fund or an index tracker fund? Super question, and this is something that really gets people stuck. So let's unpack it straight away, and in no time you're going to be an expert on understanding this difference. The first thing to really understand is, what is an index tracker? So your index tracker is this basket. It's like a bag, and inside it there's a whole lot of shares in different companies, and these are companies from around the world, and they follow different indices. And so you can get a specific bag that inside it will be shares in companies, say, listed on the New York stock market or the London stock exchange or the Australian stock exchange. And deciding what specifically shares goes into this specific bag is determined by which index you're going to follow, not by some financial guru or fund manager who's going to decide on the perfect setup, but just mirrors the index, which makes it really low cost. So to find out more about index trackers and why they're so great, you want to go and do a search on some other blogs that I've got, so you get to learn that. But so now you know that an index tracker fund is a fund, this bag, with individual shares of different companies in it. Now, you're ready to buy your index tracker, but what kind of index tracker do you want to be buying? You go on, you do some research, you find an online broker, and now you go and you've even decided your portfolio, and you know that you want a home market tracker or you want a developed market tracker. And now you see there's two primary types. You've heard of these things called exchange traded funds versus unit trust fund or mutual fund. So simply put, I've got some rice to give us an example, because one, it's cool. How cool are these bags of rice? And so that's why I chose to use it, but also because they really give you an example. A fund is just a bag with each rice grain looking like one of those shares you own. So now when you go and buy your rice, you can buy it in different forms. You can go and there's this big bag of rice, and inside it's still the same rice that you get into the smaller bag. But what is going to make the decision about whether you're going to buy this bag or this bag? So this bag represents your exchange traded fund tracker. So in this case, what happens is your fund house, so this could be Vanguard, it could be a bank like HSBC, it could be iShares, whoever the fund house is, have gone and they have put together that fund. So inside it, all the shares of the companies that follow that specific index. And then, so let's say there's this big bag, and then they allocate from that gathering smaller units, shares in this bigger pot. So it's still rice. And then they take this bag and they sell it to you via the exchange, via the stock market. So a slice of a bigger fund is divided up into smaller little bags, smaller slices, and that is sold to you via the stock exchange. So it's called an exchange traded fund. You see, once you get through the jargon, you realize it's pretty straightforward. It says what it is on the tin. So what does that mean? It means that you are buying that share of an index tracker fund via the stock market. So on your broker account, that ETF, exchange traded fund, is bought and sold just like a share in a company. So with it, there's going to be trade costs. There's going to be a buy cost and a sell cost. But generally, your ETFs have lower ongoing charges, those total expense ratios, those total ongoing charges, which are so important. And so again, you're going to buy it from your online broker platform, and you select an ETF, exchange traded fund. It's still an index tracker. It's still tracking a very specific index, whatever that is, be it the S&P 500 or a property index or whatever it is, but you buy it directly from the stock exchange. Now there's another form of index tracker fund where that same fund house or different fund houses go and create a bigger bag And they also put the same index inside. So this could be tracking exactly the same index, an S&P 500 index, an S&P 500 index. But this cool bag over here sits at the fund house. So for example, Vanguard is one of the biggest fund houses of index trackers, or maybe it's HSBC Bank, or it's Fidelity has created an index tracker, or LNG. There's all these different fund houses. And so they have a big bag sitting where they put the shares that are mirroring that index into it. And you go and own a slice of this bag, and you buy that directly from the fund house. You don't buy it from the stock market. Remember, this has been divided up and individual little components of that fund are sold on the stock market. Here, when you buy a slice or a share in a unit trust or mutual fund, you get ownership of a share in this big bag. It stays in this big bag and it stays with the fund house. Now, you're still buying rice, just buying them in slightly different ways. And for most of you, it's not really going to make a big difference. It's just going to determine which one you're going to buy, is determine what kind of online broker platform you have. In different countries, you get different access to more unit trust funds or mutual funds. That's the same word in the UK and Australia. You tend to call them unit trust funds. In the US, you tend to call them mutual funds. Exactly the same thing, also known as collective investment schemes. But you still do it through an online platform. So typically, why would you choose a unit trust or a mutual fund? If you're in, say, the UK or the US, you've got a lot of options around mutual fund, unit trust, index tracker funds. And they're these big collective investment vehicles. And because there's this aspect of economies of scale, generally, from a lot of fund supermarket platforms, you have no trading fee. Because it's not being bought and sold on the index, you don't have a buying and you don't have a selling trade fee. So there's no upfront fee. There's often slightly bigger ongoing charges than the equivalent ETF, but not necessarily. And especially in the big developed markets, you've got a lot of options here. So because you don't then have a trading cost, unit trust or mutual fund index trackers are fantastic for your regular investing. And many platforms, you can only do your regular investing, your monthly investing in a unit trust type index tracker. Remember, they are both index tracker. One's bought from the fund house, unit trust, one's bought via the exchange. So you need to look on your platform and go, okay, if I've got my regular investing in place, I've designed my portfolio, I'm going to see what's available. And for many cases, your regular investing is only going to be available in your unit trust or mutual funds. Now, in other places, so for example in South Africa, there are not many unit trust index trackers available. There are far more exchange traded funds, and more around the world, far more index tracking mechanisms are moving to the ETF version of it, where you buy and sell from the stock exchange. So many more people are investing in ETFs. If you can do it in your unit trust, great, but don't be afraid of the ETF. What's really important is you need to look at that trade cost, and that's going to impact your return, because remember, you want to keep your costs right down. And so many platforms, so for example in Europe, one of the best brokers that I really like in Europe is DeGiro, offers a whole lot of index trackers in the form of ETFs, which are trade free because they want to get you investing in these great low cost passive investment funds. So you can go and have a look and buy a great portfolio of ETFs with no trading costs. In South Africa, there's platforms which do collective buying around ETFs, which is really a great way for you to have them, so you reduce the fees. There are also many where there's almost no trading fees. So you want to just look at those options. And then if you're buying in bigger lumps, usually it's going to be more cost effective when you've got bigger lumps in regular investing or lump sums to invest via the ETF. So there you have it. You now understand that index trackers you can buy in two forms. One is via the stock market in a slice of that fund, smaller pre-packaged individual bag called an exchange traded fund. The other is buying directly from the fund house. When I say directly from the fund house, it's still via your online broker, but it doesn't go to the stock exchange. You go and own a slice of this bigger bag, and that is a unit trust or a mutual fund. Both are still index trackers. Both are these juicy passive investment schemes. So there you have it. I hope you now understand the difference between an ETF and a unit trust type of index tracker fund. The most important thing is you need to get index trackers working for you. You need to be getting that portfolio in place. You need to be doing your regular investing, because only assets create your freedom, and you need to get those assets in your life by setting up your regular investing. So get going, and I'd love to know in the comments below, which are you investing in? Are you investing in unit trust / mutual fund type index trackers? Are you investing in ETFs? And if you aren't investing yet, if you don't have your regular stock market investing in your index tracker portfolios in place, tell me when you're going to get started, because you've got to have this juicy asset class working for you. So if you're watching this anywhere other than over at thewealthchef.com, head on over there so you can leave your comments for me, ask your questions, and you're going to find great resources for you to use, including a free ebook on getting these amazing things called index trackers working for you, and how to expand your dough with these fantastic, what are also called passive investments. So I'm Ann Wilson, and until next time, keep taking those baby steps, keep getting assets working for you, and believe in your dreams.